Imagine a world where machines not only answer our questions, but autonomously carry out our decisions, collecting data, reasoning through risk, and acting on our behalf while we sleep. That world is no longer science fiction. It is arriving on the desk of bankers, regulators, and scientists today. Welcome to episode zero 05, season 1 of the Aether Vector. I'm Louis Maverick Adams. And today we're going to unpack, the biggest leap in artificial intelligence since the rise of generative models. The shift to agentic AI. Over the next 45 to 50 minutes, we'll explore why this matters for the enterprise, why it matters for our regulators, and why it should matter to anyone who thinks about the economic machinery behind the modern institutions. My background is in banking, so much of our discussion will use payments, underwriting, and marketing as anchors. But the implications extend well beyond finance into life sciences, aviation, supply chains, and public policy. We'll draw on the latest research, including global surveys and white papers, to separate hype from reality and to identify where agentic AI is already delivering measurable results. Generative AI, the family of models that write text, generate images, and produce code on demand, dominated headlines in 2023 and in 2024. Those tools are remarkable, but they are fundamentally passive. They respond when prompted, and a human remains in the loop to decide what to do with the output. The agentic paradigm goes further. According to the US National Institute of Standards and Science, of Standards and Technology, agentic systems are autonomous AI agents that can reason, plan, and act toward goals with minimal human intervention. The Information Technology Industry Council clarifies that agentic AI is built on multi-step planning and reasoning capabilities. Such systems autonomously query and select tools within boundaries set by a user to execute a user-defined task. In other words, generative AI creates, agentic AI acts. This distinction matters because it moves us from assistants to colleagues. Generative models can draft a report, and agentic system might collect data, perform analysis, draft a report, file it in the right system, and schedule the follow-up meeting without additional prompting. Agentic AI is goal-directed. It decomposes a macro goal into subtasks, selects the right tools, executes actions, observes results, and iterates. NVIDIA describes this as a 4-step reasoning acting loop. Perceive the environment, reason with a large model, act via tools, and learn from feedback. In mid 2024, the technology press began calling Agentic AI the new kid in town, and that moniker understates how quickly adoption has spread. In McKinsey's State of AI 2024 survey, 23% of respondents said their organizations were scaling an Agentic AI system with at least one business function, and an additional 39% were in pilot stages. And by late 2025, 70% of banking leaders reported Agentic AI initiatives, with 16% in production and 52% in pilots. So, in other words, most large enterprises are no longer debating whether to explore agents, they are debating how to govern them at this point. So, why now? Three forces catalyze this shift. Model capability. Foundation models now support tool use and long context reasoning. Google's Gemini 1.5 offers million token context windows, and OpenAI's Agent SDK formalizes function calls. These capabilities allow AI to hold a plan in memory, call APIs, operate software, and adapt as it receives feedback. Open source orchestration frameworks such as Lang and AutoGen provide planners, executors, and human-in-the-loop patterns. This lowers the barrier to building multi-agent workflows. Then there's demand for automation. After experimenting with chatbots, executives now demand measurable productivity gains. Surveys show that 88% of organizations use AI in at least one function, but only about 1/3 have scaled these solutions enterprise-wide. Agents promise to break the pilot purgatory by automating entire processes. With autonomy comes risk. Agentic AI can amplify efficiency, but also create new attack vectors. The National Institute of Standards and Technology warns that AI agents are vulnerable to hijacking by indirect prompt injection, where malicious data causes the agent to take unintended actions. Early Gartner polls show that only about 15% of IT application leaders are piloting or deploying fully autonomous agents, and 74% worry that such systems represent a new attack vector, and only 13% strongly agree that they have adequate governance. These statistics underscore why our discussion today will focus on control frameworks as much as technology. In banking, Agentic AI is progressing from co-pilot to fully autonomous operations. Early in 2025, most banks were experimenting with AI co-pilots for drafting reports or code, but by mid-year, 70% of banking leaders had agent initiatives, 16% were already in production, and 52% were running pilots. These agents handle complex workflows such as end-to-end loan processing and customer inquiry resolution. By the second half of the year, momentum accelerated. Citigroup's CEO Jane Fraser revealed in Q3 that 5,000 employees were piloting an agentic platform that allowed multi-step tasks to be completed with a single prompt. JP Morgan Chase built a proprietary AI suite for its 200,000 staff. CEO Jamie Dimon noted that the $2 billion investment has already matched its cost in savings. Citigroup reported saving about 100,000 developer hours per week. And this was through automated code checks. Beyond these pilots, fintech prototypes illustrate how agentic AI blurs the line between monitoring and action. Dynamic credit gating systems continuously recalculate a borrower's credit worthiness and autonomously adjust credit limits or interest rates in real time. These agents monitor transaction patterns, external risk signals, and collaborate with fraud and compliance agents to determine whether a change is warranted. Such continuous credit adjustments were not feasible at scale 6 months earlier and show how agentic decision making compresses the cycle from detection to action. Insurance regulators documented real-world use of agentic fraud screening by mid-2025, and banks deployed agents to monitor transactions and raise anomaly alerts. By late 2025, Bloomberg Intelligence observed that banks' focus had shifted from theoretical gains to measurable profit and loss impact. Executives demanded tangible return on investment tracking for AI projects. The agent paradigm is also reshaping aviation, logistics, and healthcare. Within aviation logistics, dynamic routing agents make local decisions for fleets of drones or trucks, continuously adjusting routes to reduce delays. Researchers warn that if each agent optimizes locally without coordination, the system can create new checkpoints. Multi-agent coordination frameworks are therefore critical. There's also healthcare diagnostics. AI agents act as 24/7 digital assistants for pathologists, autonomously analyzing tissue samples with 99.5% accuracy and flagging patterns indicative of cancer. Healthcare companies are building non-diagnostic agents for patient intake, chronic care management, and post-discharge follow-ups. Within insurance claims, a multi-agent system launched in mid-2025 employs specialized agents, planner, coverage, fraud, audit, etc. to process claims following disasters. This approach reduced processing time by 80%, cutting claims resolution from days to hours. There is also algorithmic trading. Financial learning models empower trading agents to autonomously process market data and execute trades on 5 to 15-minute horizons, achieving annualized returns exceeding 200% in some documented cases. While these results are eye-catching, they underscore the need for rigorous risk controls and regulatory oversight. Systemic trading risk. Researchers warn that when many agents pursue similar strategies, local optimizations can trigger market-wide cascades. The 2010 flash crash, a $1 trillion sell-off spurred by multiple high-frequency algorithms reacting to each other, and the quant quake in early 2024, where a handful of Chinese quant funds using similar AI models caused a sudden market correction, illustrate how uncoordinated agents can destabilize markets. These events foreshadow the need for coordinated protocols and circuit breakers whenever autonomous trading agents operate at scale. These diamonds in the rough illustrate how agentic AI can deliver outsized impact when applied to specific high-value workflows with well-bounded scope. Agentic AI is not confined to finance. Venture capital has poured $3.2 billion into AI-driven drug developments over the last 12 months, and AI-native biotech startups commanded a median valuation of $78 million, nearly double those of peers. Mega rounds in late 24 and 2025, such as Therapeutics, $1 billion Series A and Isomorphic Lab $600 million raise, signal strong conviction. Deloitte analysis suggests AI could cut drug development costs by up to 70%. And in silico medicine moved a novel drug to phase 2 at roughly 1/10 the typical cost. These early ROI signals are driving the investment boom. In application, AI agents are being deployed across the life sciences value chain. For drug discovery, agentic systems built on domain-specific models can generate and screen molecules, dramatically narrowing viable candidates and accelerating discovery. And then with lab automation, research groups have demonstrated GPT-powered lab agents that autonomously design multi-step chemical synthesis, control robots, and interpret results. In the area of clinical research and literature review, AI agents can scan and summarize thousands of papers, freeing scientists to focus on experimental design. Then we have clinical trial optimization. Agentic systems analyze historical trial data and real-world patient information to suggest optimal protocols, such as inclusion criteria or dosing regimens, and can simulate trial outcomes to improve success probabilities. Within the area of diagnostics and personalized medicine, agents can sift through medical images, lab results, and genomic data to detect diseases and recommend tailored therapies, acting as a second pair of eyes for clinicians. There is also, of course, operational efficiency. Beyond R&D, AI-driven agents manage inventory, plan production schedules, process documentation, and flag compliance issues. Regulatory compliance is the top use case priority for 51% of pharma executives. There is also patient and provider engagement. Conversational agents deliver 24/7 patient support, conduct preliminary system checks, and tailor outreach to healthcare professionals. In one survey, 46% of pharma executives highlighted patient support, and another 46% pointed to market intelligence as high priorities. These capabilities promise to reduce R&D cycles, and if clinical outcomes hold, increase success rates. However, experts note that efficiency alone is not enough. The next few years will reveal whether agent-designed therapies achieve higher clinical success probabilities. Looking to the next 12 to 18 months, nearly 3/4 of pharmaceutical and biotech organizations are already planning or piloting agentic AI, and about 44% report using AI agents in production. Industry surveys show that data quality, integration, and governance design remain bottlenecks. 60% of executives flag designing workflows and guardrails for AI agents as the top deployment challenge. Success at scale will depend not only on better models, but on robust data pipelines and continuous oversight. Underwriting is where economic theory, risk discipline, and governance converge into irreversible decisions. It answers the foundational questions. Should the enterprise deploy capital? At what price? Under what constraints? This decision problem is shaped by asymmetric information, tail risk, portfolio interactions, and regulatory constraints. Failures propagate systematically. Agentic AI promises to transform underwriting from a batch process into a real-time decisioning system. Consider a modular underwriting agent. A data aggregation agent gathers applicant data and external signals. A scoring agent computes credit worthiness. A risk agent adjusts thresholds based on macroeconomic indicators. And a decision agent approves or denies the loan with an explanation. Such a team mirrors a human underwriting committee but operates continuously. In early pilots, digital lenders reported experimental, fully automated loan trials under regulator sandboxes. The upside is faster decisions, lower costs, and the ability to dynamically adjust credit lines based on real-time data. However, the shift introduces new risk. Agentic credit gating systems continuously adjust credit limits and rates. If poorly governed, they could amplify pro-cyclical behavior or inadvertently discriminate. Governance must therefore enforce fairness, explainability, and escalation triggers. Underwriting decision systems should translate risk signals into thresholds, encode policy and capital constraints, and arbitrate trade-offs between growth and loss. Human review remains essential for edge cases and escalation, preserving accountability. Payments are the economic circulatory system of the enterprise. They aren't a utility function. They are a continuous decision system that operates under cost, risk, liquidity, and regulatory constraints, often in milliseconds. Payments answer the question, how does value move at what cost, speed, and risk across rails, counterparties, and time? Even small inefficiencies compound at scale. Agentic AI can optimize payment routing by evaluating multiple rails, dynamically balancing cost, latency, and risk, and applying policy constraints in real time. For example, an agent might monitor liquidity across instant payment networks, detect fraud patterns, and reroute transactions automatically if one rail becomes congested or risky. However, time is a binding constraint, isn't it, for all of us? Decisions must be made before full information is available and under strict latency budgets. This elevates the importance of preemptive controls, deterministic fallback logic, and bounded autonomy. Governance in motion means constraining routing logic and enforcing cost risk tolerances continuously, ensuring traceability without slowing execution. Marketing is where economics, behavior, and experimentation converge into decisions about deploying scarce attention and capital. So at scale, marketing is not storytelling. It really is a continuous optimization problem under uncertainty, budget constraints, and behavioral complexity. The central question really is how to allocate resources to influence demand, shape behavior, and realize value efficiently and ethically. Factors such as demand elasticity, diminishing returns, attribution uncertainty, and policy constraints complicate the problem. Agentic AI can transform marketing from a series of campaigns into a dynamic decision system. Agents can allocate budgets across channels, balance exploration versus exploitation, adapt offers and messaging based on real-time data, and enforce fairness and compliance. For example, an agentic marketing system might continuously A/B test creative, adjust spend to maximize marginal return, ensure consent and privacy compliance, and surface anomalies for human review. Such systems embed governance not as an afterthought, but as part of the architecture. Leadership must see marketing as economic stewardship of attention, experimentation, and trust. In all three domains, agentic AI augments rather than replaces human judgment. Underwriting agents can propose, but humans must sign off on unusual or high impact loans. Payments agents operate at millisecond speeds, but humans must design the fallback logic and risk tolerances. Marketing agents optimize campaigns, but humans must define ethical boundaries and creative direction. The key is disciplined decision systems that combine AI efficiency with human oversight. Agentic AI fundamentally alters the control architecture of organizations. Traditional risk management assumes discrete decision points where a human or committee can intervene. For example, a loan officer approves or denies a loan. A compliance manager reviews a flagged transaction, or a model change goes through a governance committee. These checkpoints allow oversight and auditability. Agents, however, operate continuously. A credit agent may adjust credit lines in real time. That may be based on streaming transaction data. A fraud agent may tweak thresholds, and that may occur on the fly. A routing agent may reroute payments every millisecond. These are micro decisions, and these micro decisions they happen at machine speed, and they are too frequent for humans to monitor and intervene individually. And so this creates a control challenge, or maybe an opportunity. How do we ensure that AI making thousands of decisions per second stays within policy boundaries and does not propagate systemic risk? That overall is our concern, the propagation of systemic risk. The National Institute of Standards and Technology highlights the security dimension. Many AI agents are vulnerable to agent hijacking, where an attacker inserts malicious instructions into data that cause the agent to take unintended actions. Even benign interactions, for example, a user uploading a document, could embed hidden prompts that redirect the agent's workflow. Thus, control frameworks must include a mechanism to evaluate, sanitize, and constrain external inputs. That's safety. In a similar fashion, the Information Technology Industry Council notes that agentic systems risk level depends on the degree of autonomy, the environment, and the complexity of the goal. Autonomy exists on a spectrum. Users can set the level of autonomy via design patterns, and high-risk environments may require stricter guardrails. Well, they do require stricter guardrails. Designers should implement bounded autonomy. Agents have authority to act within clearly defined limits. For example, adjusting payments up to a certain dollar amount, or approving loans below a certain risk score, for example. When thresholds are breached or uncertainty is high, the agent must escalate to a human. And drawing on these insights, an effective escalation and containment logic should include something of the following: role-based limits. Each agent should operate under explicit limits on transaction size, risk tolerance, action types. These limits should be codified in policy and can be adjusted only by authorized humans. Real-time monitoring would be the next dimension. A supervisory agent monitors other agents' actions, logs all decisions and anomalies, and triggers alerts where patterns deviate from norms. A third dimension, inter-agent communication. Agents should not operate as an island unto themselves. Fraud, compliance, and credit agents must share context to avoid conflicting actions. Then there's the element of human handoff. When uncertainty exceeds a threshold or outcomes are ambiguous, the agent must hand control back to the humans. This ensures accountability and prevents runaway effects. There is also the dimension of security hygiene. There should be continuous evaluation of inputs for prompt injection and other adversarial techniques, coupled with model hardening and safe fallback behaviors. By designing agents as components within a supervisory system rather than autonomous free radicals, organizations can harness efficiency while containing risk. However, the control challenge does not end with a single agent. When multiple agents operate simultaneously across trading desks, payment networks, or diagnostic pipelines, new risk will emerge. Independent agents optimizing locally can collectively create global distortions. The 2010 flash crash, triggered by high-frequency algorithms that were reacting to each other, erased nearly $1 trillion in value within minutes before markets were halted. A more recent quake occurred in early 2024. This occurred when several Chinese quant funds using similar AI-driven strategies all sold at once, causing a sudden market tumble. Researchers noted that without coordination, agents making routing or pricing decisions can jam networks or cause self-reinforcing feedback loops. Even in healthcare, chaining several diagnostic agents together can compound error rates. 5 agents, each 95% accurate, may yield only a 77% accuracy end to end. Traditional model validation metrics are insufficient in this type of environment. Evaluating each model's accuracy in isolation does not ensure system-level safety. Banks might trust a credit model that is 98% accurate, but if all lenders tighten credit simultaneously based on similar models, they could collectively trigger the very downturn they feared. Static documentation creates truly a false sense of control. Agentic systems adapt continuously, rendering thick binders of model documentation outdated. Regulatory guidance has lagged behind these dynamics as of late 2025. As of late 2025, banks are deploying agentic systems without clear rules, leaving them caught between cautious supervisors and fast-moving fraudsters. To address these systemic risks, oversight must move from approval to architecture. Organizations should embed policies and tripwires directly into the agentic environment. Dynamic kill switches, real-time validation suites, and AI auditors that log and explain what decisions are emerging design patterns. Continuous monitoring, staged rollouts, throttles, and circuit breakers, concepts borrowed from payment systems and capital markets, can help ensure that if multiple agents start to behave in unison, the system can pause, adapt, or revert before harm. In other words, the new control problem demands continuous supervision equal to the speed and scale of the agents. Our goal here at Aether Vector is to expand our horizons beyond core banking. So far, we've reviewed life sciences. Let's briefly survey other sectors. Healthcare providers face a severe labor and access crisis. Non-diagnostic patient-facing agents handle high-volume workflows, patient intake, chronic care management, post-discharge follow-ups, and medication reminders. These agents scale preventive care at lower cost while embedding safety through constellation architectures of supervising large language models. In pathology, agents act as digital assistants for pathologists, autonomously analyzing tissue samples and identifying patterns indicative of cancer with 99.5% accuracy. Such agents augment human expertise rather than replacing it, flagging suspicious slides and letting pathologists focus on complex cases. Insurance companies deploy multi-agent systems to process catastrophe claims. In one project launched in July 2025, a team of 7 specialized agents, planners, cyber coverage, weather, fraud, payout, and audit, collaborated to process each claim. This design cut processing time by 80%. The architecture offers a template for other high-volume, low-complexity workflows. Modern aviation relies on autonomous systems for routing, scheduling, and maintenance. Agentic routing optimizes flight paths and drone deliveries in real time. However, research into multi-agent systems shows that local optimizations can cause global inefficiencies if agents do not coordinate. Airlines and logistics firms are therefore developing coordination protocols where agents share state and negotiate trade-offs, much like aircraft following air traffic control rather than each pilot acting independently. In software development, autonomous coding agents now move beyond completion to full task automation. A developer can specify a goal, the agent writes code, generates tests, runs them, and debugs and iterates until the goal is complete. This changes the roles of developers from writing code to reviewing and guiding high-level architecture. In IT operations, proactive support agents monitor system health, predict failures, and remediate issues without waiting for human tickets. They integrate log analysis, incident response, and configuration management. These agents reduce downtime and free up engineers for innovation. Yet again, escalation protocols are vital. A misaligned patching agent could bring down production systems if unchecked. While Agentic AI captivates the imagination, market research reveals a cautious adoption curve. A January 2025 Gartner poll showed that 42% of organizations made only conservative investments in agentic AI and 31% were still in wait-and-see mode. Only 15% of IT application leaders were considering or piloting fully autonomous agents, and 74% of respondents viewed agents as a new attack vector. Forrester predicts that 3 out of 4 firms attempting to build agentic architectures from scratch will fail. 3 out of 4, because systems are too convoluted, requiring diverse models, retrieval augmented generation stacks, advanced data architectures, and niche expertise. These numbers contextualize the investment boom. Venture capital is pouring into AI, but boards are demanding return on investment. McKinsey's survey found that while 80% of high performance set efficiency as an objective, companies capturing the most value from AI also set growth or innovation objectives. The difference lies in redesigning workflows to harness agents rather than layering them onto existing processes. Given the complexity, many firms are choosing to buy or partner rather than build. Xcube Labs notes that the most successful agent applications in 2025 are specialized vertical platforms that have solved trust, integration, and governance challenges in advance. Banks partnering with trusted vendors can accelerate adoption while leveraging standardized control frameworks. Outside of core banking, mergers and acquisitions are heating up as firms seek to integrate agentic capabilities or diverse legacy functions. Consider life sciences giants acquiring lab automation startups or insurers buying AI-powered fraud detection platforms. These deals reflect a recognition that agentic AI confers a collegial competitive advantage. Operationally, chief administrative offices within products, customer experience valuations, and strategically, corporate development, M&A. Boards must assess whether to acquire capabilities, partner with vendors, or cultivate internal teams. In life sciences, the adoption curve illustrates this tension. Nearly 3/4 of pharmaceutical and biotech organizations are in planning or pilot stages with agentic AI, and about 44% report using agents in production. Yet 60% of executives cite designing workflows and governance for AI as the top challenge to deployment. This underscores that capital alone is insufficient. Successful adoption hinges on building data infrastructure, cross-functional talent, and robust guardrails. As we close, it's important to address the human architecture needed to harness agentic AI safely. The quant-human archetype, introduced in our December 2025 white paper, describes a new professional role that synthesizes mathematics, machine intelligence, economics, risk governance, systems design, and institutional dynamics. The quant human is a lattice-based integrator who can see across silos, understanding how a change in a model threshold alters unit economics, fairness distributions, capital buffers, and product design. Modern finance operates at machine speed. Liquidity runs can occur instantly, and model updates propagate across product ecosystems. Financial stability, therefore, hinges not just on capital ratios, but on the institution's ability to interpret complexity, connect information, and act cohesively at machine speed. Institutions that cultivate quant humans reduce friction, embed compliance at design time, and accelerate safe innovation. Their purpose is not to replace models or regulators, but to integrate them, to serve as cross-domain translators between data scientists, economists, risk officers, policymakers, and technologists. At the board level, leaders must view Agentic AI not merely as a technology project, but as a structural transformation. They should ask, are our decision systems integrated across underwriting, payments, and marketing? Do we have escalation frameworks that can handle continuous decisioning? Do we have the right mix of internal talent and external partnerships? And most importantly, are we fostering lattice shaped cognition within our organizations? Without integrated reasoning, the gains from agentic AI may never materialize, or worse, they may create new fragilities. Our research apparatus identifies several structural gaps that make modern finance fragile. The temporal gap arises when machine speed events outpace weekly governance meetings. Liquidity runs can unfold in hours, yet committees convene days later. The architectural gap reflects misalignment between interconnected systems and siloed responsibilities. A pricing change can cascade into capital adequacy, consumer protection, and liquidity events. The documentation gap shows how models and data pipelines evolve faster than they can be documented. There is also a data gap, ensuring data quality and representativeness. A skill gap, the shortage of professionals who span technical, economic, and regulatory domains. And a regulatory gap, the mismatch between rapidly evolving AI guidance and institutions' ability to comply. Quant humans design playbooks that coordinate responses across these gaps. The white paper proposes a cross domain risk taxonomy to make these dependencies explicit. In a credit pipeline, an error in the probability of default model affects pricing, demand, liquidity, capital, and fairness metrics. The quant human must recognize these interactions and implement tripwires. To prevent cascading failures, our triple guardrail framework embeds controls at 3 levels: data guardrails such as lineage tracking, quality and fairness checks, privacy and access controls, model guardrails, including multi stakeholder approvals, performance tripwires, explainability, bias testing, and change management. And then market guardrails like staged rollouts, dynamic throttling, risk containment, customer protections, and ecosystem coordination. These guardrails shift control upstream rather than manually approving every AI decision. We hard code limits, monitoring, and fallback logic into the system design. Building such integrators requires a 6-domain capability model. Beyond mathematics and machine intelligence, quant humans must be fluent in economics and incentives, risk and governance, product and system design, and institutional dynamics and communication. Leading banks are experimenting with rotation programs, university partnerships, and professional certifications to cultivate this cross disciplinary talent. Boards should treat these programs as strategic investments because without people who can connect code, capital, and compliance, agentic AI may deliver more risk than reward. AI is a profound leap, not just in what machines can do, but in how organizations must think. It promises to automate processes end to end to unlock inefficiencies, to unlock efficiencies across finance, healthcare, and beyond, and to reframe competition around collegial advantage. But autonomy without discipline breeds fragility. If you are an executive, this is not a time to outsource thinking. It is a time to design systems that marry AI with human judgment, to invest in people who can connect economics, risk, and technology, and to build guardrails that move at the speed of your business. The next leap beyond generative AI belongs to those who were both bold and careful. Thank you for joining me on the Aether Vector. In the next episode, we will explore the regulatory convergence shaping AI governance globally. Until then, stay curious, stay disciplined, and remember that the future of finance and of science is being written by agents that can act and humans who can think.